Sometimes it matters and sometimes it doesn't. And what I mean by that is what one stock can do in one day in many ways doesn't really matter unless it's one of those stocks that everyone seems to be looking at and it does what no one expected it to do, even though its earnings were crazy incredible. Oh my gosh, I can't believe they are this amazing. And this is how bad it turned out. Those are typically turning points. And the market today is at that part of the cycle or the price cycle where a turning point would make sense. So stick around. I'm going to talk about what stock I'm talking about and why it matters and what's really driving the market to go sideways to down. Stick around. Hey everybody, RC Peck here with Fearless Wealth. And the point and purpose of these videos is to help people retire strong. Now, I've been saying for 6 weeks, this is the 6th week in a row. This is my last market review that I'm doing for YouTube. Now, I do these for my money management clients every Tuesday, so of course they'll continue to get the market reviews. But as far as putting these out on YouTube, this is going to be the last one. If you want to be in my world and have curiosity what it would look like to eliminate what we call replication from your portfolio, then you can check us out below and look at what a portfolio x-ray would do for your portfolio. But today, let's talk about the market. This is my last market review, and there's something really juicy going on. That's a word my sister likes using. So let's talk about what this one specific thing is and why it matters for people who are retiring soon and are retired. So let's do this. Let me go over to the price charts. And the first price chart I want to show you, now this is a super zoomed in price chart right here. This is a price chart of Nvidia. Okay, it is currently a $1 trillion stock, one of only a handful of $1 trillion stocks. Now, back on May 24th, it had its earnings. It had its earnings yesterday too, but back in May, it had its other earnings and the stock popped massively. It went up about 26, 27%. And then from that pop, it kept moving higher. Okay, now here's what's interesting. When that pop happened, US stocks absolutely took off. International stocks, they just went sideways to down. But US stocks took off to the upside, like, oh my gosh, here we go again, .com 2.0 or 3.0 or whatever 0.0 we're on right now. And it was on the back of Nvidia's earnings. I mean, the numbers were insane. And that's why it popped so much. And all tech went with it. Some of the stuff people were talking about going into yesterday's earnings was like, it's a huge beat, which, by the way, it was a huge beat. Total record revenue. All the numbers were up. I mean, just look at some of these on the screen here. Earnings per share up 854% from a year ago. I mean, that's GAAP earnings. Then you just have normal, whatever other type of earnings are, up 429%. But GAAP earnings up 854. So here's the thing. Expectation is everything. And I believe people had priced in like absolute perfection. The problem was absolute perfection was priced in back in May. And it's already, if you look at any of the multiples on Nvidia, they are just incredibly sky high. People are comparing them to Cisco in 2000, which had very similar, like, oh my God, we're 10x sales and numbers that you just don't see except when things are at the top. Now, I'm not calling a top in Nvidia, but I'm pointing out a couple things. The price move, or the move of the price tells you whether it was good news or bad news. So you can go look up the earnings and everyone's going to be all orgasmically excited about how the earnings were. I got that. But if you look on the screen here, and I can zoom into this, Nvidia only had a 0.1% gain today. So let me do this. Actually, I want to zoom in here so we can see this. So this is Nvidia. It opened up 6.7% today on Thursday, and then basically closed flat. That's not what you want to see on orgasmically awesome earnings. Like, you want to see that price gap up and take off. That did not happen, but that's not all of it that I want to show you. So that's Nvidia. Now, look at SMH. SMH is the Semiconductor ETF. It gapped up today, but it actually closed down from that gap higher. It fell almost 5%. And in fact, it closed down for the day 2.6%. So that's SMH, that's a semiconductor ETF. That's something you don't want to see if things are getting better. You'd expect semiconductors to kind of all move up together with Nvidia, but that's not what happened. Look at AMD, which is another US semi-producer, and that thing just got taken out, down 7%. Now it opened higher. And so this time around, I've talked about this in a video not too long ago, is that tech earnings were getting huge pops last time around, last quarter. But even if they're killing it this time, it's not enough. And that makes sense because the market's at a turning point right now. I'm going to show you that. But the first thing that I really noticed with Nvidia was that, yeah, the price and their earnings and their revenue and their data center and their bloppity blop blop blop, I got it, did well. Okay. The price fell. So let's take a big step back and kind of look at the market. Microsoft was a leader coming into this year. It was leading the market higher. And it broke above its high of 2021. I've talked about this high of 2021 a lot over the last 6, 8, 12, 16 weeks. And Microsoft did break above that, but it came back down. That's called a false breakout. We saw the same thing with Apple. Apple broke above its old lifetime high. I'm showing you these price charts with dividends reinvested, and you see that Apple broke above and it's come down below too. This is not a sign, even if it's short term. And by the way, I'm not saying gloom or doom and the market's going to fall 35% like it did last year in the first half of the year. I'm simply saying we're still at this kind of overhead supply, overhead resistance in the overall market. And if one stock was going to take us higher and above it, it would have been Nvidia with crazy blowing out their earnings numbers. But that didn't happen. They blew out their numbers again, and the market was like, not enough. We wanted something more. You know, you're already at 10 or 11x sales. We were expecting something more. Now, this is typical what you see at turning points. Again, here's the Nasdaq 100. Up, it got up to where it fell before at the end of 2021. Couldn't quite even get into there, got into there and got kicked out. So now that's below. I'm not saying the Nasdaq's going to fall, Nasdaq 100 is going to fall 35% like it did last year. What I'm saying is there's a lot of overhead supply, and it makes sense because cash today, you can go buy a money market fund at Schwab or Fidelity and make 5 or 5.25%. Most people who are retired, they're only demanding 3 or 4% from their money, and you can get that for free for cash. And so, you know, there's this new kid on the block, and it's called actually getting interest from your cash. That wasn't around at the end of 2021, but it's around now, and it's kind of saying, hey, like, I don't have to own stocks anymore because my cash is making me real money. Now, I've talked about this before, and I'm about to hit the pause button, but I talked before. I think what's driving a lot right now is actually yields in Japan. Now, this chart might not look that important, but let me just kind of point out maybe 2 or 3 things. Where the blue horizontal line is, anything below that line means you're paying the Japanese government to give them money. Okay, at the low, you were losing 25 basis points a year for 10 years guaranteed if you bought a 10-year Japanese bond. And what's most important with interest rates is direction and speed of direction. So even though the Japanese 10-year is only yielding 66 basis points, the fact is that it used to be yielding 0 near the end of 2021, and now it's at 66 basis points. That means the Japanese government is going to buy fewer US bonds, and they're going to be net sellers of it. And the yield of the Japanese 10-year is going to influence the yield of the US 10, 20, and 30-year. Remember, the Fed's not in control of long bond yields. They can control maybe from 2 years or less with their federal funds rate. But the market sets the yield on a 10-year US Treasury or a 20-year or a 30-year, and those are breaking out to new highs. that's a sign of instability, and that's a sign of the market having to re-figure out what the value of a stock is. Because if you can now, let's just pull this up, and since this is one of the last, well, this is last, like here, right here, let me zoom in here because we're way zoomed out. So look at, let's go 6 months and see it. This is the yield. This is the yield on the US 10-year. I want to zoom out a little bit because I want you to see if I can see October of last year. This is October of last year where its old yield was. This was its 15-year high. And the yield of the 10-year broke above that this week. Pulled back a little bit, but is staying above. So now you can give the US government your money for 10 years, and they'll give you 4.23. Let's just call it 4.25%, guaranteed for 10 years. This is the competition that the stock market has not had for a very, very long time. Remember the dot-com, when that happened, if you're in the Nasdaq, you lost 83% of your money, the Nasdaq 100. If you were in the S&P, you lost 50% of your money. And you could go put your money in cash and make 5.25% for zero risk. So we're kind of more back to that type. Again, I'm not saying we're doing a 50 to 83% correction. I'm simply saying there's a lot of upside overhead and upside resistance that's happening right now. And stocks are not the only game in town. You can just buy cash right now in the US and you've got 5.25 for no risk. Okay, so let's put this all together. We got Nvidia coming out with crazy smashing, oh my gosh, I can't believe they're doing that earnings, and the price falling. Now, it ended the day up 0.1, but it opened nearly 7% high and just came down to where it opened for the close. That's not a good sign for upside movement. That's more of a topping behavior. You got Apple breaking down, you got Microsoft breaking down, you got AMD falling today, you got most chip companies falling, you got SMH, the ETF, down for the day on a day where you think the $1 trillion chip company could pull everything up, and it didn't. And so this is just a sign that there's more topping going on, more of kind of a sideways market to expect at least through the end of September. And I say this, even if you're retired, it's good to know why things are happening, right? And also like, oh, wait, I mean, 5.25 is pretty good for zero volatility. That's what Nvidia told me, or more importantly, how the market responded to Nvidia's numbers saying, yeah, I need more. Apple's down, Microsoft's down, Nvidia's down, AMD's down. XLK, the technology ETF, closed lower. Again, these are not things you want to see if you expect the market to move higher. So the takeaway is expect more sideways to down from the market, more volatility. If the amazing earnings of Nvidia can't pull the market higher, then the market is for sure taking a break. When I say for sure, I'm talking probability here. I think the big story is the rates going higher in Japan for the first time in, say, a gazillion years. That's a really big deal. That's a competitor to the US, and that's going to drive US long rates higher, which is going to tell the stock market you're going to have to reprice. I'm not willing to pay as much for that $1 of earnings, Microsoft or Apple or Nvidia or XLK or SMH. And that, I think, is the biggest story going on right now that I don't think it's getting a lot of attention, right? Meaning US long bonds going higher. And with this, because that's the market moving the rates higher, not the Fed. Thank you everybody for being in my world. I appreciate you watching my videos. I'm going to continue posting videos on Saturdays. They're just not going to be market reviews. Of course, I do my market reviews for my money management clients every Tuesday. It gives them that peace of mind. It really helps them understand what's going on in the market. If you're curious what a portfolio x-ray would look like of your portfolio and how much replication is actually costing, you might be surprised. You can go into the description and get on our calendar to do an x-ray. And if not, that's fine. Thank you so much. Leave a comment, subscribe. I'll still do videos, and like, because those all help. All right, y'all take care. Bye.